the hour. We want to make sure that we try to stay on time to the best of our abilities. Again, this is Stephen Ashton with AFG Brokerage. Glad you could join us this morning for our discussion on the planning opportunities that we're seeing in the asset-based long-term care and chronic illness insurance market. We're excited to have our resident expert, Jamie Mueller, on the line with us today. She's going to go over what she's seen in the market and some tips to help us overcome some of the myths that are out there, help us understand the different products that are out there, and then she's going to talk about really our opportunity as advisors in the long-term care market right now. So with that, thank you for being with us. If you have questions during the webinar, please feel free to unmute your line and ask them, or you can wait till the end and we'll have some question and answer time then also. Again, thank you for joining us. And with that, Jamie, I'm going to turn the time over to you.
Oh, thank you so much. And thank you everyone again for taking the time out of your days to listen to me on this topic. So before we dig in, just a tiny bit about me so you kind of know where I'm coming from. I have spent almost 20 years in this industry we love so much of insurance, multiple carriers at another brokerage general agency, and now in my current position with a sole focus on the asset-based long-term care market. I've been working with this product segment very heavily for about 5 years and exclusively for about the last 2 years. So the ins and outs of the market and where they're competitive and quite frankly where it's not, that's the value that I bring to my relationship with AFG. But the reason why I've decided to kind of make this my home for probably the duration of my career is just I'm so passionate about it. And just like, with a lot of other things, passion stems from experience. And, what my own family has gone through with 2 grandparents with a long-term care situation, I've lived it. I've seen it. And my parents are the ones that took the brunt of that situation. But, I believe in it. I feel like it's one of the most under-provided segments in our space that we work in. But yet the opportunity is probably the largest as well. So thank you again for kind of, taking the time and we'll dig in with that. So, the state of the industry, right? Why are we even talking about asset-based long-term care today? And the story here is that the story really isn't changing, okay? The statistics that we've seen for years and years and years have remained the same. So the need is not going away. In fact, it's just increasing. So you've all seen this statistic, I'm sure, in multiple places, and that's, 70%. 7 out of 10 of us, by the time we reach 65, will need some sort of long-term care services in our lifetime. That's a huge number when you really stop and think about it. Although the ironic thing is what, 90% of the people think they're going to be, in the 30%, and that's just not good math. So the need is there. We've got to be talking to our clients about this. Average stay, you'll still see statistics that range anywhere from 2 to 3 years. Some are longer, some are shorter. I have my own personal opinion about averages. They're only applicable when they apply. And as soon as you're outside of that average, then all of a sudden you don't really care about averages, right? Like my own grandfather was a 12-year stay in a nursing home. So, but got to follow the statistics, 2 to 3 years. So what does that mean as far as dollars? You're looking at close to $300,000. Genworth puts out a fantastic study every year called their Cost of Care Survey. If you haven't checked that out, I highly recommend that you do so. It's a simple Google search, Genworth Cost of Care, and they've been publishing this study since 2004, and it's very thorough, gives incredible information. Well, they just released the 2017 version last month, and the national average for nursing home care is up to $97,450 a year. That's almost a 5% increase year over year. And they're making a big deal about this. So, the need remains, the cost keeps going up, but the number of people that actually have policies in place is also remaining, very low at around 11%. So you can see, huge need, huge opportunity. But this is the story that you're going to hear more and more about over the next decade or so, and that is Alzheimer's. Okay, the average stay for an Alzheimer's patient is 8 to 12 years. And then you're looking at a price tag of over $1 million for that kind of care. And the reason why this is going to become more and more of the story is the statistics out there, the studies are showing a staggering amount of people that will be diagnosed with dementia or Alzheimer's over the next 20 to 30 years. It's scary. Okay, our bodies stay healthy, our minds deteriorate, and the cost for that kind of care is exorbitant. So the story is, how are we paying for this? Where is this money going to come from? I like the adage that when mom and dad need care, mom and dad get care. Like, no one's going to deny that to them. So it's just a matter of, again, who's paying for it? Is it coming out of their income that they've worked so hard to build? Is it coming out of the legacy that they wanted to leave? Or even worst case scenario, is it going to come out of the kids' income and the kids' legacy to make sure that mom and dad are taken care of? So, that's my little bit of a soapbox thing there. But, again, I hope that you're really, truly appreciating the situation that we're dealing with. Long-term care insurance industry has just plummeted. And this is traditional long-term care that we're all, familiar with. Year 2000, 750,000 policies were issued of traditional long-term care insurance. Just 2 years ago, only 105,000. That is a dramatic drop in coverage, considering the fact that the costs are going up and the need remains the same. And why is that? Right? It's all of the objections that I'm sure you've heard 100 million times. They don't like the use it or lose it aspect. Their clients are concerned about price increases. They're happening constantly, sometimes up to 80% at a time. Every time we turn around over the last several years, the carrier is just getting out of the space. They can't support it anymore. I think John Hancock last year getting out of that space has really contributed to the increase of activity that I'm seeing in this asset-based long-term care market. It's because of the viable alternatives that it provides. So it's really become a situation where, if you're not up to speed on this market and the value it provides, and you're not having these conversations with your clients based off of everything that I've seen over the last 2 years, somebody else is. Okay, it's the rise of this asset-based long-term care market has been absolutely phenomenal. I mean, just with the customers that I work with, we're up 80% just year over year in the activity in this space. So I think it's an extremely valuable weapon to put in your arsenal, if you will, to provide your clients. So, one of the things that I want to touch on is what I call the myths of long-term care. And a better way to think about these is objections. And I think it's important to cover these, because if you're starting to get into this space and you're starting to have these conversations, maybe it's the first time that you're really opening the door to this. These are the type of things that you're going to hear back from your clients. And there's been pretty easy ways to dispel every single one of them. So I'm going to touch on those just a little bit. But I think these myths or these objections is a big contributing factor to why we're seeing this decrease in purchase of traditional long-term care, right? They're kind of relying on these ideas as how they're going to take care of the situation. And the first one, myth number 6, is that they truly believe that, Medicaid's going to take care of me. They're going to pick up the bill. And the oversimplified answer to that is, well, yes, maybe, kind of, right? It's complicated. It's hard to qualify for. It varies, state by state and what's available to them. And by the time you get to the point where Medicaid will start picking up some bills, you've depleted all of your assets or most of your assets in order to even get to that point. So relying solely on the government to take care of this situation is not a plan that I would ever recommend be followed. This one, you're probably going to hear this one, well, I have health insurance. I think we can all agree those are not the same thing. Okay, health insurance is not going to cover the costs that are associated with long-term care. Okay, they're just not. So, that's a pretty simple one to dispel. Just be aware that you might hear that one. They think that long-term care insurance is only for nursing home. That used to be true a long time ago. It's evolved and changed so much. The products that I work with in the asset-based long-term care space provide benefits for a whole host of services. Yes, private room nursing home care, semi-private room. Yes, of course, that's covered, but so is home health care and assisted living. You can even get benefits for caregiver training. Okay, so we got to make sure that they're not thinking that. And the reason why I think this is important is how often have you heard, especially from the men in the family, that, I'll go to the nursing home over my dead body, right? They're not going. Well, that's okay, right? We can put some plans in place to cover care in the home as well. Myth number 3 is that they can't afford it. This one, you hate to, try to do scare tactics with numbers, but, start talking about those price tags, start adding it up. Where's that money coming from? Again, you show them here, well, okay, that's fine. Like, here's this bill. Where's it coming from? Is it coming out of this? Is it coming out of that? And very quickly, you can get them to see that it's actually just the opposite. I really can't afford not to put a plan in place, or everything I've worked for is going to be toppled over. Myth number 2, and this one's surprising, how many times you'll hear this is, well, we don't need any sort of long-term care protection because we have each other, right? That's their plan. Husband's going to take care of wife, wife's going to take care of husband, kids are going to take care of mom or dad. And that might work for a little while. And this is where my own personal experience comes in. But there will come a time where it's just not possible. The level of care is needed is, your average person out there, an unskilled caregiver, is just not able to do so anymore. Not to mention the fact that the emotional and financial impact that does have on families, right? One sibling's doing more than the other. I mean, it can cause rifts in families that last for years and years and years. And it's just not worth it, right? When we have options in place. And myth number 1, and this one should, just drive you nuts, being in this industry that we're in, as the people that just want to self-fund, right? Well, I can just save the money that I need. It's like I tell my kids quite often, just because we can doesn't mean we should, right? Why would you? Like, we are in the business of leveraging money in the most tax-efficient manner to accomplish goals through life insurance. Client wants to leave $1 million to a son. We don't say, great, here's how we're going to save $1 million in cash and you're going to pass it into him that way. Of course not, right? We work with life insurance and we leverage pennies on the dollar to get that done efficiently. We have that same opportunity for care. Take that $1 million that you saved and let it go where you want it to go, right? Maybe you chip in $100,000 and we let the insurance company pick up the tab for the other $900,000, but keep that money that you've worked so hard to build. Don't let it go to pay for care when there's another option in place. Okay, so now we're going to dig in a little bit here. One of the most common questions that I get is, how does asset-based long-term care insurance differ from, just a long-term care rider that you would bolt on to a UL or an IUL policy? And first, let me say, I believe that those should always be a part of the transactions that you're doing, whether it's a long-term care insurance or a chronic illness rider. I feel like it's just, good due diligence to make sure that that benefit is on that policy. But they're 2 completely different ball games that we're working with here. And really what it comes down to is the need. We got to match up the primary need to the product that we're working with. If you are needing to put death benefit protection in place for your clients, first and foremost, then yes, you'll want to look at, a UL or an IUL policy, and then add on that long-term care or chronic illness rider as kind of an added perk, right? It's ancillary. We flip that script when the focus of your conversation is planning for long-term care. That's when we want to go to an asset-based approach, right? Because the bulk of our premium in that situation is going to give us longer and more robust long-term care benefits. The fact that we've got a death benefit associated with that, that's our perk, okay? That's our ancillary benefit. That's our objection to the use it or lose it story of traditional long-term care. So it seems like maybe a very slight nuance, but it actually is it's a big deal. I was working with an advisor just a couple of months ago who had a policy declined, and it was at John Hancock, fantastic product, their Protection UL with the long-term care rider. The reason it was declined was they felt like the death benefit would over-insure the lady that he was trying to get coverage for. Doesn't happen often, but it can happen. So when I unpacked this with him, what I discovered he had been doing is backing into a death benefit based on what the LTC rider would provide for benefits. He wasn't selling this for death benefit. He was selling it for long-term care. And I had to put it to him quite frankly, John Hancock does not care that that's what you're doing. They sell death benefit first and foremost. And I use that a lot because that's the language the carriers will use. So I showed him an asset-based solution. It was actually with One America, where we got better long-term care benefits than what he was able to get with the John Hancock policy. The premium was actually less. Death benefit was, of course, significantly lower, but that was okay. That wasn't the focus. Got the app in place about 3 weeks ago. So again, that's why it's important to understand where, when we navigate in which direction. And of course, there's some major underwriting differences as well. And I know that there's some exceptions to this rule with, most of the carriers have some sort of a kind of an accelerated platform, based on age and face amounts. But for the most part, when you're working with a traditional insurance product, you're looking at a full underwriting process, anywhere from 90 to 120 days, just depending on all the different factors. Where when you're working with these asset-based programs, for the most part, there's always exceptions to every rule. It's anywhere from 15 to 20 days on average, start to finish. And then you've got your policy in place. So not only is there a difference of where we go for the need, but there's some differences in underwriting to understand too. One of the next big questions that I get a lot, and this is important because the products that we work with in the asset-based long-term care space are true long-term care products versus a chronic illness rider. Okay, and I'm not going to go into all the tax codes, but that's why they're different. Okay, it's just how they're filed and what they do. Now, when I say nuances still remain, what I'm meaning by that is I'm seeing changes in the chronic illness riders and what they will and will not cover and how they're working, which is actually really, really fantastic news for consumers. But for the most part, here's, one of your big differences is what I call permanency. What I mean by that is a chronic illness rider will not pay any benefits for a condition that is considered recoverable, where a long-term care product will. Best example I can think of is a stroke. Okay, person has a stroke, they need care for a little while, but then they get better. Their chronic illness rider will not pick up that tab, but a long-term care rider or an asset-based long-term care product will. So that's very important to understand. You have what's called mortality discounting with chronic illness riders. And again, for the most part, this is what's out there. So when you get your policy, there's language in there, and probably one of the most common is you can get up to 24% of your death benefit for 4 years. Very, very, very seldom are they actually going to get 24% of their death benefit for 4 years. Okay, they don't know what they're getting until it comes time for claim, when they actually need the money. And then they run these actuarial formulas that ultimately tell you how much you're going to be able to get. So you're not, you'll get something, but you really don't know what that's going to be. Where with a long-term care rider or policy, you know from day one exactly what your benefits will be and exactly how long they will last. And then there's per diem limits. And this can be a big one. A chronic illness benefit is subject to the IRS per diem limit. You can get, say, 24% of your death benefit. They'll give it to you. But if that amount exceeds the per diem limit, the amount over will be taxable as regular income. And again, I never want to make it sound like, taxes are the end of the world or anything. It's just important to understand that. I don't hear that as a part of the conversation often enough when working with chronic illness riders on large death benefits. Again, if mom and dad need care, mom and dad get care and you pay taxes, that's fine. It's just important to know the difference. Where with a long-term care solution, it does not matter if you're over the per diem limit. If it is considered a reimbursable expense for your contract, it's still received tax-free. And then the last, couple little differences that I think it's important to understand before we dig in deep to this market of asset-based long-term care is indemnity versus reimbursement. And both of these take part in the asset-based space. So indemnity, quite simply, is you get to spend the benefits however you want. Okay, you still have to show, your doctor has to say that you cannot complete 2 out of the 6 activities of daily living, or you have a severe cognitive impairment. And once you've done that, you get your benefits. Now, some companies will show, you have to show that there's been $1 of loss. They want to see that you are at least getting care. And then let's say if you can get $10,000 a month, you just get your full $10,000, whether you need it or not. Okay. There's pros and cons to that. Obviously, the pro is the flexibility, especially in a home health situation. You can pay even a loved one to come in and help compensate them for their time where you can't do that with a long-term care rider. The downside to that could possibly be added stress actually to the family, because then they are the ones responsible for managing the expenses and paying the bills and making sure everything is done. Where with a long-term care rider, right, most of the time you've got some sort of a bill paying service associated with that. They pay the providers directly. And then of course you have the possibility of depleting your policy, much sooner than you would need to, and maybe eliminating some death benefit that you could have passed on. And then the opposite of that, obviously, is reimbursement. It's exactly what it sounds like. They're only going to reimburse actual expenses. And again, kind of a plus side to that is what I said, the claims paying services that the companies provide can be a huge benefit to a client where they don't have to manage that process. And of course, you're able to stretch out your policy significantly longer. So the moral of the story on this is, and you'd be surprised actually how passionate people get about this and want to say one is better than the other. I do not think either one of them is better. They're just different. It's just so important that you understand the product, the type of benefits it's providing, so that there are no surprises come claim time. Okay, so just know what you're getting. So the asset-based long-term care market. Now we're going to get into the whole meat of this. There are probably 5 carriers who I consider the major hitters in this market, and they all have their own place, right, where they compete. So you've got Lincoln MoneyGuard, been around a long, long, long time, probably the most familiar name in that space to the producers and advisors that I work with day in, day out. They are still very strong for single life cases, meaning you don't have 2 people you're looking to cover. In a 4 or 6 year benefit period is very comfortable for them. They're going to be in the top 1 or 2 pretty much every single time. Okay, very, very strong. Pac Life, Pacific Life, I call it Pac Life, also has a product that's going to compete right up there with Lincoln, and it's called Premier Care. The problem, if you want to call it a problem, is they're not very friendly towards brokerage, the space that we live and breathe in. Okay, they're mostly a career distribution channel. So if You guys can even get access to the product. I'm actually not sure if AFG has that contract or not, honestly. It's hard to get. Okay, and then when
we
you
do have the contract, but it is definitely not as friendly.
Yeah, that's the best way you can put it. It's just not brokerage friendly. It's like, I don't think they even want to be here. So, but they have an extremely competitive product. Okay, so if you've got access, it's definitely worth looking at. Then you have these two. You have Nationwide and Minnesota Life. They both have a product in the space as well. Now, Nationwide's been around a little while. It's not going to price as well as Lincoln or Pac Life most of the time, but they have those indemnity style benefits. So if that's where that conversation needs to go, then know that that's a solid option on the table. Minnesota Life also has indemnity style benefits. They just came into this space earlier this year. My personal opinion is they still have some work to do on that product and its flexibility and its pricing, but I would anticipate that it could be a really key player next year. But where I find myself spending probably 90% of my conversations the last 2 years is on One America. And there's a reason for that. They have two product lines. They have what's called their Asset Care, which is your direct competition to everybody else in this space, okay, because that's our life insurance-based contract. But they also have another family of products that are annuity-based, and that's their Annuity Care line. Again, provides a huge opportunity for some different situations that we can't take care of with the other products. But the reason why I spend so much time on them is their story is so unique. What they bring to the table, nobody else is doing. So it makes it kind of a fun conversation. I'll just run through them really quickly, and then I'll show you some examples of a couple of their benefits. They are the only asset-based solution that will allow for a joint life design with a second to die death benefit. And that is huge. Okay, the leverage that we get for the premium to fund long-term care is completely unbeatable with two standalone asset-based products. You can't beat it. So anytime you've got two people, husband, wife, they don't have to be married, husband, wife, business partners, parent, child, siblings, life partners, we need to be taking a look there every single time. They are also the only provider that's going to allow for lifetime benefits. Now, way back when I was droning on, seems like forever ago for you guys, I'm sure, about these averages of 2 to 3 years. Again, a lot of people have had experiences like mine where they've had a loved one need care over 10 years. I've got a high school friend who was in an accident in 1995 and has needed care every single day of her life since 25 years. Okay. Again, lifetime benefits for the right client with the right personal situation can be an incredible value to put on the table. They're the only ones that'll give that to you. Okay.
I think the thing to remember there is that none of us are the average, right? So.
Right. Yeah. Again, you're lucky if you fall in the average, but as soon as you don't, then that doesn't mean a whole lot to anybody. They also are the only provider that's going to let you pay premiums to age 100, which that's probably the second most popular product that I work with right now is their flexible premium product. Not only does it open up the opportunity for people from a budget standpoint, maybe they just don't have a large lump sum to work with, or they don't want to move it, but they're very comfortable setting it up on a monthly EFT. It's also very comfortable for a lot of the what I call the true life guys that I work with, right? That's their wheelhouse, is monthly EFTs to get it paid for. It works. It's an easy conversation for them to have as well with their clients. No one else is going to do that. They're going to cap you off around a 10 pay. Okay, MoneyGuard tried to get a little more flexible on that to pay, but you got to be like 40 years old to take advantage of an increased flex pay, which we don't see a lot of 40-year-old opportunities. And then just two more things, and I'm going to show you some examples. They're the only one that allows for products to be issued up to age 85, and that's on their Annuity Care line. Can't tell you how many opportunities I see for 81, 82-year-olds. They just pass the window for anything else. They're not getting, a traditional LTC. They're not getting the LTC rider on a UL. They're not getting a money guard. Okay. We actually have a home for them at One America. And the same story applies to the underwriting. One America will look at anything up to a table 8. Everybody else is shutting the door at a table 4. And there's a lot of people out there that might come in around a table 5 or a table 6 that can't get anything. We have a home for them at One America as well. So again, that's why One America is such a hot topic right now in this space. So what I'm going to show you is this, what I call the power of joint life. Okay, it's amazing what they can do. So in this example, let's say we have a husband and wife, and he's 65, she's 63, and they've got $100,000 of non-qualified money to work with. And this could be, anything. This could be sitting in a CD or just cash. So long as, we're working with non-qualified in this particular example. Here's what that does. Now, I designed this. I'm not going into product mechanics on this session, so I won't bore you with that. But I designed this to kind of minimize the death benefit, but really maximize what I can do from a long-term care perspective. So that's going to get them a death benefit of just under $128,000, and that is tax-free. But what it's providing them is $38.40 a month per person for both of their lifetimes. So they potentially could get about $76.80 a month out of this policy, or just over $92,000 a year, and that does come out tax-free for long-term care for both of their lifetimes, without another penny of premium ever due, guaranteed. So how does this compare? So let me kind of lay out what you're looking at here. That top line, that's our joint life asset care. Asset Care 1 is the product that we're working with here. So 100,000 in, there's your death benefit, the combined, so the monthly $76.80 per month for lifetime. What I did on the competition is I split that 100,000 up into 2 equal $50,000 deposits for the husband and the wife, and then I combined what those 2 policies would provide. So what you can see is the next best that we could get from a long-term care perspective as far as monthly benefits is with 2 money guard policies. They could get $61.70 out per month, but that's for 6 years, and then it's gone. So $76.80 per month for 2 lifetimes forever, or $61.70 a month for 6 years. Again, you can't. And this is the story day in, day out. You cannot beat that joint life policy from a long-term care perspective. Now, to be fair and balanced, right? You can't win everywhere. So, if they need more death benefit than that, then yeah, the 2 money guard policies combined will give them more death benefit. But if death benefits your focus, you're in the wrong space anyways. And if they need 100% return of premium, again, that they're going to fall short there too. It's that trade-off, right? Which lever are we pulling to the top? ROP is going to be down towards the bottom with One America most of the time. But the interesting trend that I have seen probably over the last 4 to 5 years is that return of premium is becoming less and less and less a part of this conversation. I personally feel like it was a bit of a crutch when people were first dabbling in this space. It was almost like look how great this is, but if you don't like it, you can get all your money back. Like almost like an afterthought. Well, what we're discovering is nobody surrenders asset-based long-term care products. They just don't. The persistency on these products are extremely high. So you saw MoneyGuard do this a while back where they dialed their return of premium back. I know it's not 100%. You can do 100%, but nobody does, right? If you're going to leave it there anyways, why not put more money to work for your care? In fact, Pac Life just recently allowed for that option as well. They're dialing that back too. And I think that trend will continue. Let's put more dollars to work for the actual need that we're solving for, and that is the long-term care. So again, I just really hope this paints the picture that if you've got 2 people with an insurable interest, and this is important, no more than 25 years apart in age, have us take a look at this for you. Have your AFG team take a look at this for you. And I think you'd be really impressed with what comes back to you. So the last thing I'm going to close on today is what I actually believe is the biggest opportunity for growth next year. And I've seen a tremendous amount of activity this year. And that's working with annuities. Now, I know most of the people that I work with, and when people, advisors, producers, they say, Jamie, I don't write annuities, right? I focus on life insurance, and that's fantastic. Odds are your clients have an annuity in their portfolio that somebody else wrote them. Okay, so you don't have to be the one who have been writing these annuities to unpack these opportunities. So just in 2016, $2.8 trillion of annuities were issued. Okay, and that's a mix of variable and fixed and index, qualified, non-qualified, but $2.8 trillion in just 1 year. And you can just, look at the history here, right? That's the only thing I could even do that math of how many have been issued in the last decade, but it's a lot. So is this number, 73%. This was a 2015 Gallup poll that was done where they asked annuity owners, what are you going to do with your annuity? 73% said they're going to use it to pay for a catastrophic illness or nursing home. That's huge. That's $2.1 trillion of the 2.8 that was issued last year that could ultimately be used to pay for exactly what we're solving for. I mean, how many opportunities do we have where the public is literally telling you what to do with their annuities? And we have an amazing solution. And again, this is with One America with their annuity care line. Before I show you this example, let me just spend 1 minute on why these are so powerful. And it's called the Pension Protection Act. And I apologize, I don't have a slide on this. But in essence, what it's allowing these certain annuities to do is, and they have to be compliant with the Pension Protection Act, which One America's are, is for non-qualified annuities only. Okay, you can 1035 exchange over tax-free, but if they're accelerated for long-term care, which these products are designed to do, those benefits also come out tax-free. So if you've got some non-qualified annuities out there with some substantial gains in them that are sitting there earmarked to pay for care, that's going to be taxable. Or we move it over to these solutions and we get it all out tax-free. It's a really, really cool thing that they've got going on. So here's how this would work. Now, we're not going to, and I apologize, I'm sorry, I just completely skipped ahead of myself. Let me back up for 1 second. That is one opportunity. We're actually going to cover that in the next webinar. But here's another opportunity that I see quite a bit. So let's say they do have this annuity, but they don't want to move it over. And this is what I was telling about earlier with their flexible premium structure. And this is one opportunity to use that. So what we're going to do is they're going to hold on to this $250,000 annuity. And this is my same couple as I had before, okay, 65 male and 63 female. They don't want to move it over just now. Well, that's fine. We'll show you that one in the next webinar. But let's just take a distribution out of there. Let's say it has a 10% free withdrawal, and we're going to just take 5% of that. So we're still going to leave them some liquidity should they need it for any other sort of an emergency. So what does that equate to? A 5% withdrawal. Now I'm assuming 100,000 cost basis on this and 25% tax bracket. So let's say a net withdrawal would be $93.80 a year. Here's what that gets them. That gets them $162,000 death benefit, and it gets them $6,500 a month, or up to $13,000 a month if they're both on claim. Again, for both lifetimes, tax-free. It's $156,000 a year potentially out of this policy. And the best part about this, as compared to a traditional long-term care policy, is that $93.80 premium is guaranteed. It can never increase. Even if they wanted to, they can't do it. So how does that compare? And this one gets a little trickier. How does this compare to, say, taking that annuity and funding two actual life insurance policies? Well, the biggest problem you're going to have is finding a second to die life insurance policy that you can actually cover both people for long-term care. So this top line here, that's our joint life asset care, okay, that we just went through. The only option that I'm aware of in the traditional life space is with Nationwide, and that's their NLG second to die policy. Here's how that would look. If we funded that with $93.80 per year, we are going to have a higher death benefit, which, you know, we've covered. That's normal. But they're only able to get $41.92 a month out of that policy for 50 months. Again, that's not where they're going to focus a bulk of their premium. So, you know, $1,300 forever or $41.92 for 50 months. Now, let's say you split up that $93.80 into two individual no lapse guarantees. This is with Nationwide. Or even we put it into two John Hancock protection ULs with long-term care riders, because that's a very strong product that I see as well. Here's how that stacks up. Death benefit with the two policies combined is $333,700. But again, 67, this is total, this is combined, $67.75 for 50 months. About the strongest competitor we could get with this would be with John Hancock. Really strong death benefit on that, and around $8,000 a month combined, again, for 50 months. So again, this is a little bit more of a complicated picture to tell, but I am hoping this is showing, again, that power of that joint life. And I've shown you one example with a single premium dump in, and then I've showed you an example of just repositioning a portion of an existing asset on an annual basis that we can still accomplish some really, really powerful solutions here. So I'm going to just close with two little tidbits that, again, I find are helpful when working in this space or getting started in this space. We all know that, you know, you got to have stories as a part of your sales process, kind of like the sales 101. And, you know, when we work in life insurance, it's an emotional sale. Okay. You take that, you know, up another level or two when you're talking about long-term care. You have to come in with stories to tell in order to connect with people emotionally. This is the, you know, it's the ultimate emotional sale, because nobody wants to think about getting sick, right? And especially a lot of men in the families, their minds just won't go there. They just can't. They can't ever think about not being able to take care of their families. So have some stories that you can try to connect with people on from personal experience. If you don't have any stories, you can borrow mine. Just use them, okay? But probably the best piece of advice I can give is called, you know, good, better, best. I think of this as a car wash analogy. Okay, when you go to the car wash, you have a menu of options to choose from basic all the way up to, you know, super duper preferred. And how that relates to what we're talking about is, you know, I see all too often where, you know, an advisor is doing an amazing job doing their homework. They know the exact cost of care in their neighborhood, and they come in solving for 100% of the potential cost of care. It can make your clients just run the other way with, you know, a little sticker shock, right? My advice on that is to come in somewhere in the middle. Okay, it's very easy to dial down or up, but if you come in at the tip top of the possible scale, it can be a hard conversation to restart once they've seen, you know, maybe a price tag like that they might not have been prepared for. So with that, thank you again. I hope you found some sort of value on this, and you know, be thinking about some opportunities that maybe you could have your AFG team take a look at. So I'm going to hand it back over to that crew.
Thank you, Jamie. We sure appreciate everybody joining us, and we appreciate Jamie. One thing I will mention is you do have the ability to run One American quotes through our website. They have a really simple platform, and it's on the dashboard under the One America Asset Care Solutions Calculator. And if you're just needing a real quick one, that's a nice place to go, but also you can always reach out to us directly, and we can definitely help you with any of that. Jamie, would you mind just hitting the unmute button? And I just want to make sure if there are any questions for myself or for Jamie, that everybody has an opportunity to ask those while we're all on the line. All right.
We're unmuted. They're just very quiet.
Right, with that silence, I'm going to guess maybe nobody had any specific questions. We will reach out to you. Someone from the AFG brokerage team will reach out to you this week to follow up with you on this and see where that will fit in your clients and how we can help you to get some of these cases going. So again, we thank you for your time this morning and appreciate Jamie coming on and sharing her wisdom with us. Hope everybody has a fantastic day and Merry Christmas.
Thank you. Thanks, everybody.
I think someone had a question, Jamie.
I do.
Oh, okay. I'm still on.
Yes, Jamie, you made reference to, I couldn't write fast enough. This is Charles Fisher in Eugene, Oregon.
Hi, Charles.
You made reference to the difference between the chronic illness and the long-term care riders. You said that chronic illness will not pay for a condition that is blank. I didn't catch that.
Okay. I lost you for a little bit. I heard chronic illness will not cover, and then I couldn't catch what you said.
I couldn't get what the what that word was.
I think the person had there was permanency. So just talking about recoverable or non-recoverable conditions.
Okay, because the example you gave was a stroke, that somebody could have a stroke and they could recover quite a bit of it.
Right.
But the chronic illness will not pay for that.
Yeah. So what they're going to do is, when they get these doctor recommendations, if the doctor has deemed this as a recoverable condition, the chronic illness riders are not going to pick up that tab. They've got to be permanent. Now, I will say more and more are adapting on that to start covering some, non-permanent conditions, which is a great thing, but we're not all the way there yet. So that's the kind of the rule of thumb that we still look at right now.
Do you have people that say to the effect of, well, gee, the $36.80 per month, that's nothing compared to what the real cost is? And I guess that gets back to your discussion of how much they can afford, how old they are, how much of it you're trying to actually protect of their assets. And so,
yeah.
But
it's a balancing act. It's a balancing act, absolutely. So, very seldom do I see people move over enough money to, provide $12,000, $15,000 a month. I mean, they happen, but most of the time we're repositioning a portion to provide at least a hedge to help protect the rest of the assets in place.
Okay, and then to clarify, make sure I understand, it's $36.80 per person and $7,200 for one person.
Right. It's per person. That is per person. Like husband can't use wife's benefits in that situation.
Okay. Well, it's been a tremendous amount of great information, and I imagine you have power lines that you didn't get to that I would love to hear a presentation as to how you actually presented what your story is.
Yeah, well, get with Stephen or Tony. If we need to do a follow-up, happy to do that with you.
All right, thanks again.
On a one-on-one.
Sure.
Yep, absolutely. Charles, just reach out to us and we'll set something up. Did anybody else have any questions while we have Jamie on the line? Okay, I don't think I see any other questions. Jamie, if you wouldn't mind just hitting the record button, and we'll